Hello and welcome to a Complete Wealth Special Update. I'm Battye, and today we're here to talk about the latest impact in markets and potentially economic impact of the coronavirus. I'm joined by Matt Armstrong, our Head of Investments. Hi, Matt.
Hi, Matt. How are you, mate?
Good.
Thanks for having me on board.
And Christopher Sutherland from our systems team, who's here to make sure everything runs nice and smoothly and we get through this and we don't get too technical. So, Matt, if I start with a question of that probably is being played out on most people's mind is how bad is this?
Yeah, look, it's obviously concerning and troubling times. Whenever there's a health crisis, that's concerning. So, by all measures that I've been aware of, there are quite a few people that are at high risk. So, the elderly or people with poor lung health or other low immune system need to be really careful. The mortality rate outside of China seemingly isn't too bad for the rest of us. I guess the rest of the population that's reasonably healthy, around about 1% mortality rate. So from a health point of view, it's very concerning for some people, and the rest of us probably just need to behave properly and make sure that we are doing the right things to not put anybody else at risk. From an investment point of view, look, there's been a lot of panic selling in the last fortnight. So markets have come off quite a lot in the last 2 weeks. But across the board, our portfolios are holding up quite well. And while this is definitely a distressing event for the world, it's not something that is unexpected from a portfolio construction point of view. We do kind of expect to have a large drop-off around about once in every 5 years. So the portfolios are kind of built to substantiate something like this happening, on a fairly regular basis. So it's serious in one sense. It's also not so serious in a portfolio construction point of view.
Yeah, so we talk about, what's foreseeable versus what's predictable, and then ultimately what's actionable in terms of the way we approach investments. And certainly there's thousands of things that are foreseeable in terms of markets that don't come to hand, right? So it's one of those things things are very easy in hindsight because of how many things are foreseeable. For things to be predictable, we need to be able to understand when they're going to occur and to sort of what quantum. But I guess the ultimate issue then is even if you can predict something accurately, can you still be in a position to take some action that allows you to benefit from it, or talk a bit about the way we do portfolio construction and how prepared we are for this sort of market volatility.
Yeah, certainly. So look, we use, value managers predominantly in the global space. So we are looking for investment managers that are looking for companies that are sustainable long term and can sustain economic hits in the short term. So as long as your businesses that you invest in don't go broke through the economic downturn, then you don't lose any money. As far as constructing the portfolios to accommodate people that are drawing down from their portfolios. So if somebody's in pension phase or they're in a situation where they need income and money from their investments, then as a general rule, we'll probably have around 30% of the capital that's not exposed to the share market. So that allows you to leave your growth investments in the market for the longer term, and that's how you get the long-term average and a reasonable rate of return on your growth assets. So rather than trying to predict the direction of the market, whether it go up or down, that's a kind of a surefire way to lose money, because even the best predictors of it get it wrong probably 50% of the time. It's more about understanding how the market works and allowing your growth assets to stay in there and get the long-term average. And it's a get-rich-slowly scheme, but it also protects your capital on the downside. So if you own good companies that don't go broke, you won't lose money. And then if you allow your growth assets the time to recover, traditionally after a downturn of more than 10% in the US market in particular, the year after that tends to be around about a plus 30% rate of return. So whilst you're in the middle of a downturn, it feels a little bit uncomfortable, but if you stick to your strategy and allow your assets to run their course, then you'll get a good return over the next sort of 2-year period. So it's about making provisions for your short-term expenses and then making sure that your growth money is allowed to stay in the market for the longer term.
You talk about people who rely on income from their investments, and obviously we know that even in relatively severe economic downturns, what we don't see is a lot of dividend volatility. If we look at, say, the average in the Australian share market, your average 1 year standard deviation of price return or market volatility return is somewhere around a sort of 13% per annum. Whereas we find it with dividends, it's more like 1% per annum. So these dividends don't really change much from year to year. Why is that, do you think? Do you think people understand why that's the case, and exactly why don't dividends change much year to year?
Yeah, I think it's a good point to make. So in layman terms, I guess what Matt just said is that the price of shares bounces around like a yo-yo, and it's plus or minus 13% on average per annum, whereas the dividends are pretty constant. They don't really change. So you're up and down maybe 1% per annum in the dividends. So the reason I think that is that your dividend is a share in the company profit, and the company profit rarely changes too much in a 12-month period. So companies also effectively announce what that amount's going to be at the beginning of the period, and often set that at an artificially low level. So what they would prefer to do is have the dividends, paid out at a slightly lower level, and then in the year when they have a really good year, they'll pay out a special dividend, or they'll do a share market buyback, which allows more cash flow that's unnecessary in the business activities to go back out to the shareholders. And the reason they do that is because they really don't want to cut the dividend, because if the dividend gets cut, it sends a pretty bad message to the market that we're not profitable anymore, our profit is falling. So whenever you send a message like that to the broader market, if people are uncertain about what's going to happen with your business in the future, they're probably inclined to want to sell it, and you'll see a decline in the share price over that time, just because there'll be more sellers than there will be buyers for that particular business. So I think a really good example is through the GFC. So that's the most recent and probably the worst market to look at over the last 100 years. So the dividend yields in Australia for a lot of companies actually increased through that period, because a lot of the businesses wanted to show strength to the market, because they were worried about sell-offs and their prices going down further. And there was around about an 85% payout ratio maintained. So through the worst market in 100 years, where we had to restructure the banks and we had to make sure that insurance companies were liquid so that the economies wouldn't fall to pieces, 85% of companies maintained their dividends at the stated rate, and a lot of businesses actually increased it. So I think that's the main thing to understand, is that your entitlement to income, or the cash flow you're going to get from these investments, is unlikely to change, but the price will change on a daily basis based on the emotions of the people that are investing in the market.
And I guess that's one of the reasons why it's really important that particularly people who are relying on that steady cash flow, is they have that buffer, that sort of cash flow moat, if you like, to be able to draw on if there is a little bit of volatility or in timing of that. But it doesn't need to be a huge portion of the portfolio at any point in time, simply because we don't see those huge interruptions to dividends.
Yeah, exactly right. So everyone needs a cash bucket for their short-term expenses, and you might have an emergency or something that's unplanned. So what you really don't want to be is in a position where you're ever forced to sell your growth assets, whether they be shares or property or infrastructure or anything that's longer term in nature, because if you are forced to sell at a time like this, you're definitely locking in a loss. You're guaranteed to sell your shares that were $10, 2 weeks ago for $8.50 or less, depending on what you own. And then you lock in zero income going forward, because interest rates are so low at the moment. So taking your money out of shares, where you're getting at the moment a 6% average sort of dividend yield across the ASX 200, to put into cash to protect against further losses in the short term, means you're taking 6% income and turning it into 1%, probably heading towards zero as the government's cut further rates. So certainly selling now would create a capital loss and also basically obliterate your income. So definitely staying the course is the best possible outcome for all people at the moment, but certainly anyone who's relying on income from their investments, it would make no sense to sell out of a 6% yield into a 1% yield. Yeah,
and as you say, if we look back through the GFC, which was certainly a very troubling economic time throughout the world, cash flows were maintained through that period, so there really wasn't a major cash flow crisis in terms of portfolio. So, but in terms of what this virus impact is having, obviously it's having huge impact in terms of markets, but there's a lot of now changes in behaviour being driven by isolations and cancellations of entries in and out of countries, etc. What do you think the economic impact of this could be then in the medium term?
Yeah, look, I think definitely there will be an economic impact. So in the medium term or the longer term, I don't think it will be huge. I think that my assessment of this, and certainly I'm not a medical expert, is that, but more from an economic point of view, is this is kind of an interruption rather than a deep-seated recession or long-winded downturn in production, for instance. So at the moment, if people can't go to work, then that's going to have an impact in the output of all businesses. And also, if your customers can't use your goods and services because you're no longer able to travel, if you're a travel agent or if you're an airline, then it's going to have an impact on your profits in the short term. Governments will try to fend that off with stimuluses, and certainly the US have a very big motivating factor running into an election year. So Donald Trump is not going to want to go to an election on the back of a recession. So he's going to do everything in his power to stimulate the economy through government spending and other rate cuts. Certainly interest rates are heading towards zero in the US and domestically. Scott Morrison's come out with a similar stimulus package, which will probably grow over the next period. But there's an emphasis on spending money on small businesses and also on consumers who are likely to spend their money. So, one, there's an impact on the stock market because of panic selling and people not understanding the quantum of what's happening, and uncertainty always creates that sort of level of uneasiness or panic. But there will be a real economic impact on businesses, and in particular small businesses in the short term. There'll be some winners coming out of this as well. So medical protection companies, utilities companies, providers of staples, your Woolies and your Wesfarmers, private hospitals, these types of businesses, IT and IT infrastructure businesses, as people have to set up remotely and work from home, they're all going to do actually quite well. Another guy told me that his fishing business was booming because people are in isolation, so fishing's not cancelled. So there are some actual winners in the current sort of cycle, but there will definitely be an economic impact in the short term. Medium term to longer term, I think this is more of an interruption, because once the isolation is over and the virus is contained or there's a vaccine created, then suddenly the borders open up again, everybody goes back to full production, and on the back of that you've got zero interest rates and governments that are motivated to keep the locomotive rolling. So I think there's an impact. It will be a shorter-lived one. The recovery will come fast and swift once the borders are open again.
And so what do you think is the real danger here? Is there a danger for investors in general, or is it really just a case of waiting?
Yeah, look, the danger is to waver from your strategy. So if anybody of our clients or anyone in particular, if they've gone into growth assets in the last few years, they should have been told at the start that this money needs to live there for 5 to 7 years, because about 1 in every 5 years on average, the market goes down. So if you went into shares with a short-term time frame, then your strategy was broken from the beginning. So if your strategy was to allow your growth assets to sit in the market and let the market do its thing and just collect the long-term average, then it's really important when something that looks a bit nervous or a bit different to that strategy comes along, that you don't change your behaviour and do something that will destroy your wealth. So from an investment point of view, it is remembering the basics and ensuring that you are invested in good companies from the beginning that won't go broke through an economic downturn. And importantly, I think most of the pain is going to be felt in the small business sector. So if you're a small business owner, you have to be really diligent in how you cut costs and make sure that you've got provisions to keep your business open, get talking to your local ministers and your governments, and get hold of all the grants and everything you can to keep the doors open and employ your staff, and make sure you've got other ways of selling your products. If you were a hand-to-hand salesperson, you need to get an online presence. So the pain, I think, will be felt in the small business sector. I think larger businesses, and certainly the ones that we're invested in, will have large cash reserves and are sitting on millions, if not billions of dollars, and can absorb some losses in the short term. And then effectively looking at, if you are proactive and if you are a little bit more aggressive in nature, or you are sitting on cash, is saying, all right, well, that dividend yields of above 6% across the ASX 200 and price to earning ratios of 10 to 12, which is well below the historic averages. When is a good time to buy back in? When is a good time to play offense? And when's a good time to deploy some of that capital that's not in the market now and take advantage of the recovery? Because on average, the market in the US tends to recover after a drop of 10%. It tends to recover the year after on average around about plus 30%. So there are going to be some good opportunities coming. If the market does end up in recession, if we do a local recession or a US recession, it will get worse before it gets better. But it doesn't mean that your strategy's broken. You still need to stick to your guns and allow your assets the time in the market to recover. And the recovery is like to be even better. So after a recession, the market tends to recover around plus 40 to 44%. So that will be when the real opportunities come. So if you look at the way that the smartest people invest their money, they are forever invested, and when they see an opportunity like this, they get their hands on as much cash as they can and they buy more assets, and they keep building on that pool, and that generates more income and more future cash flow. The sum of all your future cash flows is the value of your investments, and that's how you make good money over time. So
that's so talk about the difference between the GFC and then this type of event, because they're very different, aren't they?
Well, yeah. Look, I think the difference with the GFC is it was potentially the impact there was long term and substantial, because it was a potentially collapse of the banking system, which is really underpins everything. Where this is, as Matt was saying, this is a medical thing, and it might be very severe, and it might be extremely severe for some people, but it doesn't look like it's particularly severe for the broader population. What will matter is the behaviour impact. Do people simply stop, living their lives in a normal way? And because one person's, expenses is another person's income, and so, if we stop doing that, then we're not going to keep that economic engine going. But it's a good point, Matt. It's the old adage, I suppose, that you actually lose money when the market goes up, not when the market goes down. Because if it goes down and recovers, you're back to where you are. But the market does not go down to where it was before. When we're not, the All Ords isn't heading back to 100. It's not heading back to 500.
Definitely.
So that idea of, missing the up is really where, that's where wealth is lost. And we see that through things like the Dalbar study in the US, where we can separate the investment return that the market gets from investment behaviour, where you can actually see what returns investors have got based on the actual returns in their accounts. And the long-term average is about 4%, regardless of what the market return is in the long term. The market return could be 8, 9, 10, 12%. Investors on average get about 4%, and that's because of that behaviour of, moving in and out of the market at the wrong times. So
yeah, definitely. If you missed the top couple of trading days in a financial year, the market could do 15% and you could get 0. It's that simple. So the only way to the movements are swift. So certainly the markets overshoot on the top end, and they definitely overshoot on the bottom end. So if you're trying to guess the direction, you're bound to lose money at some point. So yeah, then the only way to get the average is to participate in the market, and to do that, you have to allow yourself a certain amount of time frame to ride out the highs and the lows.
All right. So where to from here, Matt?
Look, I think from an economic point of view, I've got no doubt the coronavirus will have some impacts on GDP of the major countries. Certainly, China's looking at a negative quarter, and I think they should follow up with a rebound in the second half, which is good because we do have a lot of trading with China, and certainly it's one of the largest economies. So I guess the number of people infected is going up at a slower rate than the number of people that are being healed. So hopefully China gets back to full production by the end of March as they come into warmer months. I think certainly Japan will struggle again. Q1, Q2 will be down. However, inflation around the world is really low. Definitely all the governments around the world are going to continue to try and stimulate their economies with cutting interest rates and certainly with stimulus packages. I expect the Reserve Bank to cut rates here again. That'll probably go to 0.25, even possibly to 0, which will be something that's uncharted for us. Shares will certainly get better, and they're offering terrific value right now. It's just when is the exact time to move back in, I don't know, and I don't pretend that I'll ever know the answer to those types of questions. But certainly there's good value, and whether they've actually bottomed out now or not, we won't know, but it's pretty good buying at the moment. I think that there's probably still a 50-50 chance of a potential recession in the US, but they're very motivated to not allow that to happen. And you're right, it'll come back down to the behaviours of people. So at the end of the day, we need to sort of behave properly. Hoarding toilet paper and doing daft things like that is probably not going to help anybody. Think about, your fellow man and how you can best support the economy and everybody else, the weakest members of your community, by doing the right things. But the quicker we get back to ordinary activity around spending and doing what we would normally do on an everyday sort of cycle, is going to push us into the right trajectory from avoiding a recession and things getting back to normal. But look, I think definitely there is still a lot of upside potentially from all of the growth assets at the moment. So it's just going to be a bit of patience. Now, stick to your strategy. If you need money, you should have cash sitting there already. You're still going to get your dividends through this period, so there won't be a dividend crash, so your income is still secure. And literally just back to the basics, the compound interest is still the most powerful thing. It's going to continue. Things will get better, but they might get worse before that happens. So if you're ever worried about it or you have concerns, talk to your advisor and get their opinion on exactly how things are. But the media is going to make you feel scared. The reality is that your strategy should be well built and it will be robust. If you've seen one of our planners and you have an investment plan in place, you're still on course, and this is what we expect to happen about 1 in every 5 years. It's just that the GFC was pretty long and deep, and we've had 10 good years following that. So it's ordinary behaviour. We just need to follow our good strategy and make sure we don't do anything that will allow us to lose money.
Right, so that's pretty much a wrap for today. Thanks everyone for joining in, and if you've got any questions, as Matt said, hit us up on the phone, send us an email, and we look forward to serving you with more into the future. Thanks.